What do a German bund, an Italian handshake, and a quiet Treasury sell-off have in common? They're all signs of something deeper. Global trust is fracturing. We're entering a new era of global distrust. And it's not theory, it's already happening. According to Deutsche Bank, Chinese clients are starting to reduce their U.S. Treasury holdings. Not because of yield, but because of unpredictability. Renewed tariff tensions are raising concerns about long-term stability in U.S. policy. From the perspective of global investors, it introduces uncertainty around how predictable and investable U.S. assets will remain. It's not just about headlines. Recent market data shows bid-ask spreads on U.S. Treasuries have widened. That's a sign of stress and lower liquidity in what is supposed to be the most liquid market in the world. That capital isn't disappearing, it's seeking further diversification. Other sovereign bonds, like German, Japanese, and other EU countries, are seen as alternatives. Meanwhile, gold is enjoying a strong run. This isn't panic selling, it's reallocating. At the same time, Trump now says he's reluctant to raise tariffs further. Why? Because, in his words, at a certain point, people stop buying. It's a rare admission. Even strategic tariffs have a cost. Italian Prime Minister Giorgia Meloni visited the White House. Trump praised her and called her one of Europe's strongest leaders. He said he expects a trade deal with the EU but didn't offer much more. For Meloni, this was diplomacy with high stakes. Italy exports over 65 billion euros to the US every year. And tariffs are already hitting key sectors. The EU is increasingly caught in a squeeze between aligning more closely with the US or maintaining space to navigate globally. According to reports, the US has urged senior EU officials to choose a side. Some briefings suggest future trade talks may hinge on the EU distancing itself from China. One recent flashpoint, a Chinese EV battery supplier for Tesla, contemporary Amperex Technology Co. Limited, or CATL, is trying to go public. Reports suggest the US government is pressuring American banks to back off the IPO. It's another signal that geopolitical lines are hardening, even in the private sector. And it's forcing companies and capital alike to rethink how global they can really afford to be. This shift away from treasuries reflects a deeper concern. Geopolitical risk now plays a bigger role in capital decisions. The benefit? More diversified global flows could reduce dependence on a single system. European markets may gain influence as investors seek alternatives. The risk? A more fragmented global market may mean less predictability, higher volatility, and fewer neutral zones. If trust in U.S. assets weakens too far, it could force central banks, investors, and governments to rethink what safe really means. Also, volatility in treasuries leads to wider price spreads. That's a growing concern for investors seeking minimum risk. If you want more global stories like this, hit like and subscribe. We break down what the headlines miss and follow the money when things start to shift. This is about more than trade. It's about control, confidence, and capital flows. And when those shift, markets follow. What else is shifting? Travel, academic partnerships, and business trips are increasingly prioritizing domestic over international exposure. And more importantly, they're being more cautious with devices and tech infrastructure. If you like this topic, watch The Silent Shift in Tech Trust, and what it means for all of us. Link in description.